Hello, and welcome to Smart Mortgage Insights. I'm Mandy LaRose.
And I'm Conor Lavinka. Today, we are going to talk to you about private mortgage insurance, also known as MI or just simply mortgage insurance. It's a topic that is often a source of confusion in our industry because mortgage insurance actually protects the lender. It does not protect you as a borrower. Mortgage insurance is in place to protect the lender if you default on the loan. And so it is something that you're required to put down on a monthly basis, to pay on a monthly basis, rather, if you put down less than 20% on a conventional loan. We're going to talk about a couple of other types of loans briefly, but for the moment, we're just going to talk about conventional loans. And it is something that is completely necessary. Mandy, why is it so necessary and why is it such a topic of conversation so many times?
Well, like you said, it is a fee that basically it protects the lender is what it's for. So a lot of people look at that and go, "Why do I have to pay that?" Well, like you mentioned, unless you put 20% down, you're going to pay monthly mortgage insurance on a conventional loan or PMI. Mortgage insurance is based generally on credit scores and the amount of money that you're actually putting down. So the better the credit you have, the more money you're putting down. Like, say, if you're putting 10% down versus 5%, you'll get a better rate as far as on your PMI on a monthly basis. So yes, it's not protecting you in any way. It's not like your fire insurance or homeowner's insurance that's going to protect you if something happens to the home. It's not life insurance. It's not going to pay off the mortgage if something happens to you or your significant other on the loan. It's just there to protect us in case you ever default on the loan. And the reason being is it's expensive when we have to foreclose on a property. So that monthly premium basically helps to recoup any of those costs when it comes to defaulting on a loan.
What if I don't want to pay it every single month? Can I just pay it once?
You can, as a matter of fact, yes. So again, um, based on credit scores, the better the credit score you have, the cheaper it'll be. But you can buy out the mortgage insurance, so you can pay a one-time fee at the time of closing. That will buy out the mortgage insurance altogether, and then you won't have to pay it on a monthly basis. So you'll just pay it as a one-time fee.
That's a relief. Do I have to pay it forever?
Well, you're gonna just pay that one-time fee once. As far as the mortgage insurance goes, if you're gonna pay on a monthly basis, you're gonna pay that until you reach by law, it'll drop off once you have 22% equity into the mortgage. So once you've reached a 78% loan to value, based on when you bought the home, so we're talking about the value from when you bought, paying down 22% into the mortgage, then that mortgage insurance, your servicer is gonna remove that mortgage insurance. Now, when you hit an 80% loan to value, so you have 20% equity into the property, again, based on when you purchased, what the sales price was versus what you owe on it now, you can request from the servicer to have the mortgage insurance dropped off, and they're going to review your payments, review your history and everything. And assuming that all those payments have been made on time, more than likely they're going to drop that private mortgage insurance. Another way of possibly being able to drop it as well is just your equity has gone up. Maybe you haven't paid that full 20% in, but values have gone up like they have the last several years. Again, this is totally up to your servicer. It's their discretion to determine if they're going to drop the value based off of, drop the mortgage insurance based off of your new value. And they might have you prove that value based on getting an appraisal, a broker's opinion, or something like that to show that your home is now worth what it is.
Definitely. And make sure to talk to your loan originator. Some programs with multifamily, you may not be able to drop the mortgage insurance, and some servicers may not allow it. So make sure to have that conversation with your loan originator about your plans for the future with mortgage insurance on whether or not you can drop it and what the procedures are to do that. Okay, so we've covered mortgage insurance on how that affects conventional loans. Now there's a huge portion of loans out there that are insured by the government that we would like to touch on a little bit. The first one is a major program called FHA. Could you tell us a little bit about that, Mandy?
Absolutely. So the FHA loan It's a very popular loan. Federal Housing Administration. It does not stand for first time home buyer. I mean, it's confused a lot, but
Yep.
so the FHA loan, you do the minimum down payment is 3.5%, and with FHA you have two mortgage insurance. You have an upfront mortgage insurance that gets financed into the loan, and then you have a monthly mortgage insurance that you pay on a monthly basis. It's the mortgage insurance that you pay on a monthly basis. Unlike conventional, it's a set amount. It doesn't matter what your credit scores are or anything like that. It's a set amount if you put the minimum down. And if you do put the minimum down on an FHA loan, you will pay mortgage insurance for the life of the loan. So, and I know people hear that and they're like, whoa, I don't want to do that. Well, keep in mind that most people don't hang on to a loan for the life of the loan. So, FHA is a great vehicle to get into a mortgage, but not something that you have to keep forever. So, you can always refinance out of that loan into a loan that would drop mortgage insurance eventually, or once you have that equity into the property, you could refinance into a conventional loan and no longer pay the mortgage insurance. On an FHA loan, however, if you do put 10% down or more at the conception of the loan, then you will pay mortgage insurance for 11 years. And at the end of 11 years, that mortgage insurance will go away at that point as well. So that's the basics on the FHA. So why don't you tell us about what happens on a VA loan?
Absolutely. VA loans are incredible for our veterans. They do not have mortgage insurance that you pay on a monthly basis, which is a huge advantage and a big thank you to our veterans. In place of that, they have what's called a funding fee. And they will have three different classifications. It will either be the first time use, which is what they consider a first time home buyer for that program, or a subsequent use that is a slightly higher amount, both of which could be financed into the loan. Or finally, if you receive disability from the VA, you're actually funding fee exempt. And so you would not need to pay mortgage insurance on a monthly basis, and you would not need to pay a funding fee. So the VA program is a really, really great deal, and it can save you a ton of money on that monthly mortgage insurance. There's one more government program that we wanted to touch on, and that was the USDA program, or what's called the Rural Development Program. Mandy, can you tell us about their requirements?
Yeah, so on their particular loan, they do charge again an upfront fee, which is a guarantee fee. It is financed into your loan, so it's not something you have to pay out of pocket. And then you're also going to pay a monthly mortgage insurance as well. And again, that mortgage insurance, like FHA, is paid for the life of the loan. It's a minimal amount, but it is still required on the loan, and you will pay it for the life of the loan. But just like the FHA loan, you can refinance out of that loan once you reach that equity threshold where you have that 20% and go into a different option, assuming that you fit into all those parameters and get out of that loan. These loans are used to get you into a property, but you do not have to hang on to a loan forever once you're in it. There's always other opportunities to get out of that mortgage and get into something else.
Finally, the government insured loans are really great options for targeted groups of people. An FHA loan is really great for a lower barrier of entry. They tend to accept lower credit scores and higher debts to income. They do have a maximum fee that you can get into a loan on, so there is that drawback. A VA loan, quite simply, you need to be a veteran that has that entitlement. And finally, with that USDA loan, it needs to be in a rural area. You cannot be within 40 to 50 miles of a major metropolitan area. And finally, they have income limits as well. So these government programs aren't for everyone, but they are really, really great if you can fit into them.
Absolutely.
Hope you enjoyed today's episode, and we look forward to seeing you next time. This podcast is sponsored by Residential Mortgage LLC, NMLS numbers 167729, 196 576, and 1820404. Equal housing lender.